In this video, I'm going to tell you my favorite thing about being a real estate professional. Make sure to stick around for the entire video because what I share at the end will likely surprise you and might even get you to consider switching careers. Hey friends, welcome back to the channel. If you're new here, my name is Sunny and I'm a real estate investor based in Northeast New Jersey. On this channel, I share my investing experience in an effort to help you start or grow your real estate portfolio. Today, I want to share my favorite part about being a real estate professional, and it's most likely not what you think. It's not the excitement of buying low and selling high. It's not the sense of accomplishment you get from adding massive value to a distressed property, and it's not even the thousands of dollars in passive income you can generate on a monthly basis. It's something else entirely. But before we dive in, I feel compelled to do a quick disclaimer. Do not take anything I say in this episode or on this channel for that matter as financial advice. This is for informational purposes only. Please consult with your CPA and tax attorney to ensure you're staying within the limits of the U.S. tax code. All right, let's dive in. My favorite part of being a real estate professional is the tax-free income. In just a second, I'm going to walk you down the path I'm taking right now to wipe away most, if not all, of our tax liability on an annual basis. But before we do that, let me tell you why you should spend the next 10 minutes listening to what I have to say. I invested in my first real estate deal back in December of 2016, and I didn't figure out how to apply what I'm about to share with you until the 2020 tax year. It took me 4 years and almost 40 separate investments and countless conversations with other full-time real estate investors to learn what I know now. And I'm about to give you all of that knowledge for free. In 2020, not only did my wife and I pay virtually nothing in taxes, but we also secured a little over $113,000 in carry-forward losses. That means the first $113K we make in 2021 won't be taxed. And if I play my cards right, we'll have even more carry-forward losses for 2022, despite growing our take-home incomes in 2021. Here's a little taste of what we'll be discussing in the rest of this video. There are 4 main concepts you need to understand to move you closer to the goal of tax-free income. And between each concept, there is a high hurdle you're going to need to overcome. The first thing you need to understand is the concept of depreciation. Depreciation is a non-cash expense the IRS allows you to apply on your profit and loss statement at the end of every year. So even though no money is leaving your pocket, you can write off depreciation against your passive income. We'll go over what this looks like in a second. But first, let's outline what it takes to qualify for depreciation expense. Since land alone cannot be depreciated, you must have improvements on the land with a useful life. Examples of land improvements include paved parking areas, driveways, fences, outdoor lighting, and the building itself. You must own the property or own the entity that owns the property. You can't depreciate something you don't own. Third, the property has to be income generating, so you can't take depreciation against your primary home or a vacation home you're not renting out. And finally, you have to be able to determine the useful life of the property you are depreciating. Generally speaking, residential property is evenly depreciated over 27.5 years, and non-residential property is evenly depreciated over 39 years. Okay, so now that we understand how to qualify for depreciation, let's walk through an example of how depreciation offsets the income of a rental property using one of my properties as an example. In September 2020, we bought a 3-family property for $215,000. Of that $215,000, we attributed $190K towards the property and improvements and $25K towards the land value. Since we can't depreciate land, we can only depreciate $190K over 27.5 years or $6,900 per year. To understand how this $6,900 in depreciation per year helps us, we have to now take a look at the profit and loss statement for this property. As of today, this 3-family home generates $3,750 per month in rental income. Here's a rough breakdown of our monthly expenses. We spend $150 on property management, $225 on property insurance, $635 on taxes, $100 on water and sewer, $100 on the landline, and then another $100 on common area utilities. Over the life of our 30-year loan at an interest rate of 4%, our interest payment averages out to $510 per month. Then we also budget 8% of gross collected rents for vacancy and 16% of gross collected rents for repairs, maintenance, and capital expenditures. That leaves us with a net operating income of $1,030 per month. Now, you can't write off mortgage principal, so our taxable income on this property before depreciation will likely be $12,360 per year. After applying the depreciation expense to our P&L statement, our taxable income on this property will be $5,460 per year. So instead of paying taxes on the $12,360 that made its way into our pocket, we will only pay taxes on $5,460. That's less than half of what we earned here. Now, at this point, you might be thinking to yourself, but Sonny, you said tax-free income, and you're right. We didn't wipe away all of our income using the standard straight-line depreciation method. But to that I say, but wait, there's more. This brings me to the next concept to understand: accelerating depreciation through a cost segregation study. A cost segregation study is a process that looks at the element of a property, splits them into different categories, and allows you to benefit from an accelerated depreciation timeline for some of those building components. So instead of depreciating the cost of the property evenly over the span of 27.5 years for residential property or 39 years for non-residential property, you can hire an engineer to identify individual components of the property that have a shorter useful life, typically 5, 7, or 15 years. Once the engineer identifies all the components that have a useful life of fewer than 20 years, you can then take 100% bonus depreciation in year 1 for all those items. Let me demonstrate at this point with a bid I recently received to do a cost segregation study on my 4-unit mixed-use property. Here's what the report said. If I take the standard depreciation on this property, I could expect to write off $267,000 over 27.5 years, which comes out to about $9,700 per year. If I perform a cost segregation study with 100% bonus depreciation, I can write off up to $47,000 in year 1 alone. This is where things get really interesting. Not only am I then going to be able to wipe out all of the income from this property, but I'm also going to be able to wipe out the passive income from my other properties as well. Now, this sounds pretty good, right? Unfortunately, it's not that simple, and this is the point in which we encounter our first hurdle. There's a catch to excessive passive losses. The Tax Reform Act of 1986 added Section 469 to the U.S. Tax Code, which says passive losses are capped at $25,000 for rental real estate activities. Not only that, but rental real estate losses up to $25,000 may be deducted by an individual whose modified adjusted gross income is less than $100,000. The $25,000 exception is phased out at the rate of 50 cents for every $1 of modified adjusted gross income over $100,000. So if your income exceeds $150,000, the $25,000 offset is not even allowed for you. Now, why did Congress put this in place? The answer is kind of obvious. When wealthy people receive tax breaks, it's typically a hot topic in the United States, and they stepped in to plug the loophole. Prior to 1986, high-income earners like doctors and lawyers sheltered their wages and business income with passive losses from real estate. A physician, for example, could earn $500K per year, buy a few rentals, and accelerate their depreciation. Their rentals would create a large enough loss that would offset or even eliminate the tax burden on their $500K of income. But then in 1994, Congress made a slight adjustment to the Section 469 of the tax code. Section 469 now allows a taxpayer qualifying as a real estate professional to deduct all rental real estate losses regardless of how high their modified adjusted gross income might be. Now, here's the issue. Qualifying as a real estate professional is super tough, and it's not an area of the tax code you should try to game. To qualify as a real estate professional, a taxpayer must meet the following 2 criteria. Number 1, more than half of your working hours throughout the year must be spent materially participating in real property trades or businesses. Number 2, you must perform more than 750 hours of services during the taxable year in real property trades or businesses. What does that mean? At least 51% of your time has to go towards materially participating in real property trades or businesses, and the minimum commitment is 15 hours per week. In other words, it will be really difficult to qualify for real estate professional status if you work a part-time job, and nearly impossible to qualify if you work a full-time job. If you're wondering what qualifies as real property trades or businesses, Section 469 of the tax code outlines 11 of them. There's development, redevelopment, construction, reconstruction, acquisition, conversion, rentals, operation, management, leasing, or brokering. If you're an entrepreneur involved in multiple real property trades or businesses, you may group them for purposes of meeting the hours requirement described in Section 469. For example, you can be a real estate agent with a property management business that does a few flips a year and count all of that time towards your 750 hours. And as long as you spend more time doing that than any non-real estate related trade or business, you should be able to qualify as a real estate professional for tax purposes. In the case of a married couple filing jointly, one spouse must achieve both number 1 and number 2 on their own, meaning spouses cannot combine service hours for the purposes of achieving real estate professional status. This is why you might see spouses of high income earners often take a position as a real estate professional as either a realtor, broker, property manager, or otherwise. If the couple can acquire rental properties and take advantage of accelerated depreciation, they can effectively wipe out the high income of one partner through the real estate professional status of the other partner. And oftentimes, the income tax savings for the higher earning partner can be more than the gross income earned by the real estate professional partner. Before moving on from this point, I want to be super clear about material participation. You must be involved in the operations or the activity on a regular, continuous, and substantial basis, which brings me to our next hurdle. The burden of proof is on you. Keeping a daily log of how you spend your time is probably your best bet if you want to be taxed as a real estate professional. And even then, your time must be spent doing things that affect the day-to-day operations of your business. You can't count research and education towards your 750 hours, nor can you count travel time, analyzing deals, or reading investor reports. Here are some examples of time that counts towards your 750 hours. Time spent acquiring property, showing the property to prospective tenants, writing and placing rental ads, taking tenant applications, running background checks and screening tenants, preparing and negotiating leases, cleaning the units after a tenant moves out, doing repairs yourself, purchasing supplies and materials for use on rentals, communicating with tenants, responding to their complaints, collecting rents, and evicting tenants. Basically, you have to self-manage your rentals. All right, so let's say you qualify as a real estate professional and you're able to take accelerated bonus depreciation after performing a cost segregation study. Congratulations, your passive losses probably exceed your free cash flow, so you've achieved tax-free income. If it sounds too good to be true, it's because it is. There's one more hurdle to overcome. If you ever want to sell an investment property, you will have to pay a tax called depreciation recapture. Depreciation recapture is assessed when the sale price of an asset exceeds the tax basis or adjusted cost basis of a property. What does that mean? Let's go back to using my 4-unit mixed-use property as an example. I bought that property in March 2021 for $315,000. Let's say I take bonus depreciation in year 1 for $47,000. My new cost basis will be $268,000. Let's say at the beginning of year 2, I find out the property could sell for $400K and I want to cash out. My taxable gain wouldn't be $400K minus my purchase price of $315K. My taxable gain would be $400K minus my new cost basis of $268K. So now I have to pay ordinary income tax on $133,000 gain, even though the property only went up in value by $85,000. The reason for this is simple. Since depreciation of an asset can be used to deduct ordinary income, any gain from the disposal of that asset must be reported and taxed as ordinary income as well. But don't worry, there's a workaround for this as well, and we're ending on a high note. If you want to avoid paying depreciation recapture tax, you have 2 options. The first option is to refi till you die. Instead of selling the property, you can periodically perform a cash-out refinance to tap into any locked-up equity. Every few years, as you pay down your mortgage and the property presumably increases in value, you can refinance your mortgage and pull some of that cash out to stuff your pockets. So let's say you've completely depreciated the property down to 0. Instead of selling it and paying a bunch of ordinary income taxes on the gain, you can just hold the property until you die and let your kids sell it at a stepped-up basis. They will inherit the property at the current market value and sell it for the same, which means they won't have to pay taxes on the gains because there likely won't be any. The second option to avoid depreciation recapture tax is to perform a 1031 exchange. A 1031 exchange is a swap of one investment property for another that allows capital gains and ordinary income taxes to be deferred. For capital gains taxes to be deferred, the properties being exchanged must be considered like kind in the eyes of the IRS. If used correctly, there is no limit on how many times or how frequently you can do a 1031 exchange. But beware, a 1031 exchange is not easy to execute. First of all, you can't touch any of the money from the sale of one property before buying the next property. That means you need to send the money to a 1031 exchange intermediary. Second of all, there are 2 timing rules you have to abide by. The first is the 45-day rule. And the 45-day rule says you have 45 days to identify a property you want to buy. And if you don't identify a new property to buy within 45 days, you will be taxed on your gain from the sale of your first property. The second timing rule is the 180-day rule. The 180-day rule says you must close on the new property within 180 days of the sale of the old, and if you don't, you'll be taxed on your gain. Finally, to completely avoid paying any taxes on the sale of your old investment property, you can't walk away with any cash or originate a smaller loan amount when buying the new property. So let's say you sell your old property for $1 million and there was a loan for $750K on it. In this scenario, you will need to send $250,000 to the intermediary. You have to use all of that $250K towards your new property and be sure to get a new loan for more than $750,000. So basically, you need to buy something that costs more than what your last property sold for. If you fail to do that, you will pay taxes on any cash you don't use or any negative difference in the loan amount originated. At the end of the day, it's not easy to put yourself in the position to generate tax-free income. It took me years to learn how to do it, and sometimes I still feel like I don't know what I'm doing. Despite how difficult it is to achieve, I think the benefits are worth it. Taxes are most people's largest expense, especially high-income earners. It's worth figuring out how to avoid them as long as you're doing it in a way that the tax code supports. Before I sign off, I want to do a quick recap of what we learned here today. First, familiarize yourself with the concept of depreciation. Then, get a little more advanced and start reading up on accelerated depreciation through a cost segregation study. More likely than not, you'll hit the speed bump of passive loss limitations. If you like what you heard in this video, it might be worth switching careers in order to qualify as a real estate professional. If you're married and your spouse wants to work in real estate, that's another way to achieve the benefits of unlimited passive losses. Depreciation recapture tax is a toll you aren't required to pay. You can either take local roads by adopting the strategy of periodically performing a cash-out refi till you die, or you can simply skip over the toll altogether by completing a 1031 exchange. I hope you enjoyed watching this video as much as I enjoyed making it for you. If you want to watch more videos like this from me, please check out this video right here. And finally, I put out a new video like this every single week, so if you haven't already, please be sure to subscribe to the channel. All right, peace.